Long before there were computers, before there were even nations as we know them, a shopkeeper in a small town faced a question as old as commerce itself. Should I let this person take the goods now and pay me later? The entire modern apparatus of credit scores, the three-digit numbers, the agencies, the algorithms, quietly weighing your financial life is really just the latest answer to that ancient, deeply human question. Tonight, we are going to trace the long, strange journey from the shopkeeper's memory and the town's gossip, all the way to the silent number that follows you today. For the shopkeeper, in a small, stable community, the answer to this question arrived relatively easily, drawing on years of accumulated personal knowledge. Did this customer pay their last bill? Did their neighbor mention they had been struggling recently? Was their business thriving, or had there been talk of difficulty? The shopkeeper's assessment was imperfect, sometimes generous to people it should have been cautious about, sometimes cruel to people it misread, but it was fundamentally human, embedded in relationship and context, capable of taking into account the texture of a life in ways that any summary number never can. It is worth holding on to this picture as we trace the long arc of what came next, because the tension between the shopkeeper's contextual knowledge and the statistical model's scalable consistency runs through every chapter of the history we are about to explore. Because here is what is worth sitting with right at the start. That three-digit number is almost certainly influencing your life right now in ways you may not have fully mapped. The apartment you live in, or the one you were turned down for. The interest rate on a loan, which can translate into thousands of dollars of difference over the life of a single car purchase. In some countries and industries, even a job offer. And yet, most people who carry this number through their adult lives have only the vaguest understanding of how it is actually calculated, who calculates it, why it is structured the way it is, and whether the entire system, which feels as fixed and official as a law of nature, was in fact designed by anyone in particular, with any particular goal in mind. The difference in dollar terms between a very good credit score and a poor one, applied across a 30-year mortgage, can amount to a genuinely large sum, sometimes tens of thousands of dollars more, paid in interest over the life of the loan, for money borrowed to buy the exact same house from the exact same lender. This is the practical financial weight that a three-digit number can carry across a lifetime. A person with an excellent score and a person with a poor score might be neighbors, friends, members of the same family, similar in income, similar in how carefully they think about money, and yet the number attached to each of them quietly shapes how much of the future they can access, at what cost, and on what terms. Understanding what that number actually is, where it came from, and what it does and does not measure, is not merely an academic exercise. It is knowledge with direct, tangible stakes. It was, and the history of how it came to exist and how it came to hold the influence it now does is considerably stranger, more contested, and more human than the cold, mathematical authority the number seems to project. But let us start somewhere closer, right here, in the world you live in, at this moment. Let us begin with the simplest possible description of what a credit score actually is, and then slowly build out the layers that make it genuinely interesting. A credit score is a numerical summary of your perceived creditworthiness, your likelihood, as estimated by a statistical model, of repaying money that is lent to you. It is expressed as a number within a defined range, and a higher number is generally taken to indicate lower risk, meaning a lender, looking at your score, sees it as a sign that you are more likely to repay on time, while a lower number signals greater perceived risk of default. In the United States, where the modern credit score was first developed and where its influence is perhaps most deeply embedded in everyday financial life, the dominant scoring model produces scores ranging from 300 to 850, with most commercially used scores produced by a company called FICO, which stands for Fair Isaac Corporation, named after engineer Bill Fair and mathematician Earl Isaac, who founded the company in 1956 and produced the first broadly adopted credit scoring model. Scores above roughly 700 are generally considered good, scores above 800 are considered excellent, and scores below 600 are considered poor, meaning lenders will either decline to offer credit or offer it only at substantially higher interest rates to compensate for the perceived risk. The practical consequences of moving between these ranges are worth appreciating concretely because they illustrate just how much financial weight a three-digit number can carry. The interest rate available on a mortgage, for instance, can differ meaningfully between an excellent score and a merely adequate one. And this difference, applied across a 20 or 30-year loan, can translate into tens of thousands of dollars in additional interest paid over the life of the same loan. The rate available on a car loan, a personal loan, or even a credit card follows a similar pattern, with higher score borrowers consistently offered better terms than lower score borrowers, regardless of other factors that might seem equally or more relevant to their actual ability to repay. A person who improves their score from the borderline range to a strong range does not merely gain a larger number. They gain access to a meaningfully different set of financial options at meaningfully different prices, an outcome that can compound significantly over a lifetime of financial decisions. This single score is calculated using 5 broad categories of information drawn from your credit report, the underlying document that credit bureaus maintain about your borrowing history. Payment history, meaning whether you have paid your bills on time, is the single largest factor, typically accounting for roughly a third of the total score. A single late payment, particularly a recent one, can noticeably lower a score that was otherwise strong, precisely because payment history is weighted so heavily and because the recency of information matters so much to how the model interprets it. A payment that was 30 days late will have less impact than one that was 90 days late, and both will have considerably less impact a few years after the event than they did in the months immediately following it. The amount of debt you currently carry relative to your available credit limits, sometimes called credit utilization, is the second largest factor. This component measures how much of your available credit you are actually using at any given moment, calculated as a percentage. Someone with 3 credit cards, each with a limit of $5,000, who is carrying a balance of $1,500 on one of them and nothing on the others, has a utilization rate of 10%, which is considered very favorable. The same person, if their financial circumstances had led them to carry a combined balance of $10,000 across those same cards, would have a utilization rate of 66%, which would significantly lower their score even if their payment history remained perfect throughout. This is why credit utilization can fluctuate considerably month to month, since it reflects the balances at a particular snapshot in time, and why paying down balances shortly before a lender is expected to pull a credit report can genuinely improve the score seen by that lender, even if the underlying financial situation has not fundamentally changed. The length of your credit history, meaning how long your oldest account has been open, matters as well. The mix of different types of credit, mortgages, credit cards, installment loans, contributes a smaller amount, and recent applications for new credit, which are recorded as inquiries on your report, play a smaller role still. These 5 categories, weighted together in a proprietary formula, that the companies responsible for them do not fully disclose, produce the three-digit number that then travels quietly and without your direct participation between lenders, landlords, and in some contexts, employers, shaping what you are offered, at what price, and sometimes whether you are considered at all. It is worth understanding a further distinction within this system that affects a great many people's day-to-day credit decisions, the difference between a hard inquiry and a soft inquiry. When you apply for new credit, a credit card, a mortgage, a car loan, the lender typically pulls your full credit report in what is classified as a hard inquiry, and this inquiry is recorded on your report and can modestly lower your score for a period because applying for new credit is interpreted by the statistical model as a possible signal of financial stress. When you check your own credit score, or when a lender checks it for pre-approval purposes without your having formally applied, this typically registers as a soft inquiry, which does not affect your score at all. This distinction matters practically because many people hesitate to check their own credit score, worrying they will hurt it by doing so, when in fact, checking your own credit carries no scoring consequence whatsoever. It also matters because shopping for a mortgage or a car loan, comparing rates from several lenders within a short window, is typically treated by scoring models as a single inquiry rather than multiple separate ones, recognizing that rate shopping is a financially sensible behavior that should not be penalized by the system. Many people do not know this and avoid comparing lenders out of a mistaken fear of damaging their score through multiple applications, which means they sometimes accept a higher rate than they needed to, entirely because the system's rules were never explained to them clearly. It is also worth knowing that the number lenders actually see when they pull your credit is not necessarily the same number you see when you check your own score through a consumer-facing service. FICO produces numerous different scoring models, some tuned specifically for mortgage lending, some for auto lending, some for credit card decisions, each weighted somewhat differently to reflect what the relevant lenders have found most predictive in their specific lending context. A consumer checking their credit score through a bank app or a free monitoring service may be seeing a different model entirely, sometimes a Vantage score, a competing scoring model developed jointly by the three major bureaus, or a different version of a FICO model from the one a particular lender happens to use. The underlying data in your credit report is the same across all of these, and so the scores will generally track each other reasonably closely, but they will not be identical, and the score you see is not necessarily the exact score a specific lender will see. This is not an error, and it is not a cause for alarm. It is simply the consequence of a system that is considerably less unified and considerably less singular than it presents itself as being. There is a second layer of the mechanism worth understanding clearly, because the separation between the credit report and the credit score trips up a great many people who would otherwise understand the system reasonably well. Your credit report is the underlying document maintained by the three major credit bureaus in the United States, Equifax, Experian, and TransUnion, that records the raw history of your borrowing, every account you have opened, every payment you have made or missed, every time a lender has requested your report, every debt collection action, every bankruptcy. The credit score is derived from this report, but it is not the report itself, because the three bureaus operate separately and do not always share data with one another in real time. Your credit report can look slightly different at each bureau, which means the score calculated from each report can also differ. This is why you may hear people refer to having multiple scores, and why a lender pulling your credit at a given moment may see a score that differs from the one you checked yourself the previous week through a different service. The underlying system is not a single, unified record, but a set of parallel records maintained by competing private companies, all using somewhat different data and somewhat different scoring formulas, producing somewhat different numbers, all of which, nonetheless, carry considerable authority over major financial decisions in your life. Under the Fair Credit Reporting Act, consumers in the United States have the legal right to request their credit reports from each of the 3 major bureaus once per year at no charge, to review them for errors, and to formally dispute any information they believe to be inaccurate or incomplete. The Bureau is then required to investigate the dispute within a specific time frame and either correct, update, or remove the disputed information if it cannot be verified by the source that originally reported it. The dispute process is worth understanding concretely because many people are unaware that it exists or assume it is more difficult or less effective than it actually is. When you submit a dispute, the Bureau is required to contact the original source that reported the item, whether a lender, a collection agency, or another creditor, and ask them to verify the accuracy of the disputed information. If the original source cannot verify it within the required time frame or does not respond, the Bureau is required to remove or correct the entry. This process is far from perfect, and consumer advocacy organizations have documented cases where disputed information was verified and reinstated without meaningful investigation of the underlying dispute, a genuine shortcoming in how the system functions in practice. But the legal framework at least creates an obligation on the bureaus and their data furnishers that did not exist before the Fair Credit Reporting Act, and that obligation does result in the correction and removal of a significant number of errors when it is actually invoked. Errors on credit reports, including accounts belonging to someone else with a similar name, payments incorrectly recorded as late, accounts that should have aged off but remain, and debts that have been paid but still show as outstanding are not uncommon. And the Consumer Financial Protection Bureau has documented substantial numbers of consumers finding significant errors on their reports, because these errors can meaningfully lower a score. Reviewing your own reports periodically and disputing inaccuracies when found is one of the most straightforward actions available to anyone concerned about the accuracy of their credit picture. Your credit score is only as accurate as the underlying report it is calculated from, and the underlying report is only as accurate as the humans and systems that put information into it, which is to say, not perfectly accurate, and worth checking. It is worth pausing on a specific implication of the two-score system before we move into history, because it matters for how people relate to their own score in practical life. Two people can have the same credit score through very different paths. One may have a perfect payment history, a long and varied credit history, and consistently low utilization, representing genuinely careful, sustained financial management over many years. Another may have a credit score of identical numerical value because of a particular combination of account types and ages that simply happen to produce the same model output. Even with a somewhat less distinguished underlying history, the number does not reveal which of these people you are looking at. It cannot. It is a summary statistic, and summary statistics, by definition, compress all the complexity and context of an individual story into a single point. Understanding this does not make the number less influential in your financial life. It simply makes it easier to hold the number in proportion to what it actually represents, and makes the anxiety that sometimes forms around it somewhat easier to examine clearly. But to understand why this system took the specific shape it did, and why it carries the specific authority it now does, we need to go back. Not because history is interesting for its own sake, though it very often is, but because the present, on its own, does not fully make sense without it. The shopkeeper's question, "Should I extend credit to this person?" is as old as trade itself, and the earliest answers to it were purely local, purely personal, and entirely dependent on direct human knowledge. In a small, stable community where everyone knew everyone else, a merchant could answer the question of creditworthiness through direct personal observation, knowing from years of interaction whether a particular customer paid their debts reliably, whether their business was sound, whether their word could be trusted. This system worked well enough within its natural limits, the limits of a world where most economic life happened within a radius small enough that everyone could reasonably know or know of everyone else. There is something worth appreciating about the quality of knowledge this older system sometimes produced, even as we trace the reasons it could not scale. The shopkeeper who had served the same family for 20 years had a genuinely rich picture of their financial behavior, one that included not just whether they had paid previous bills, but why they had sometimes struggled, what their income was like in different seasons, whether their difficulties were temporary or structural, what their character was like under financial pressure. This depth of context is exactly what the statistical model, with its access to payment records and balances and account ages, cannot reproduce. And its absence is precisely why the score can feel so inadequate as a description of a financial life actually lived in all its complexity. The gain in scale that the modern system achieved over the shopkeeper's personal knowledge came with a real, structural loss in contextual depth, a trade-off that the system's designers understood but had no practical way to avoid. These limits began to strain as economies grew larger, as people moved between towns and cities with greater frequency, and as trade expanded beyond the tight radius of personal acquaintance. A merchant dealing with strangers, or a lender doing business in a city where no single person could know the financial reputation of every potential borrower, needed some way of extending the reach of personal knowledge, some mechanism for finding out what the people in a position to know already knew about a particular individual's reliability with money. The earliest formal attempts to solve this problem emerged in England in the early 19th century, as industrial cities swelled with migrants from the countryside, and the volume of commercial credit extended between merchants and manufacturers grew far faster than any single trader could personally track. Groups of merchants in specific industries began to share information informally among themselves, passing along word about customers who had failed to pay their debts, customers who had gone bankrupt, customers whose word had proven unreliable. This informal sharing of negative information, blacklisting in its most literal form, was the earliest ancestor of the modern credit bureau, built not on any systematic data collection, but on the mutual self-interest of tradespeople who understood that their collective knowledge was worth more than what any one of them possessed individually. The specific texture of these early English credit circles is worth dwelling on, because it reveals something important about the nature of the problem they were trying to solve and the limitations of the solution they reached for. A draper in Manchester might join a trade association whose members shared a list of slow-paying customers. When a new customer arrived, the draper could consult the list, but the list only reflected the experience of other association members in that particular trade, in that particular city. A customer with a spotless record with drapers, but a long history of failing to pay ironmongers, would not appear on the drapers list at all. And a customer who had left Manchester and moved to Liverpool would leave behind whatever reputation they had built or damaged, since the list did not follow them across the distance. These were genuine structural limitations, and they meant that the informal shared blacklist, however useful within its natural domain, was inherently local and inherently incomplete. The United States followed a similar path, with the first credit reporting organizations appearing in the middle of the 19th century, often tied to specific industries or specific cities. The Mercantile Agency, founded in New York in 1841 by Louis Tappan, is often credited as one of the first genuinely large-scale attempts to systematically collect and sell credit information. Employing a network of correspondents across the country to report on the creditworthiness of local merchants and business people, distilling their reports into brief assessments that subscribing businesses could consult before extending credit to an unfamiliar party. Tappan's innovation was to understand that the real asset was not any single merchant's experience with a particular customer, but the aggregated knowledge of a large enough network that a genuine stranger, arriving in a new city or conducting business across state lines, could be assessed based on the collective memory of people who had dealt with them before. The Mercantile Agency built this network by recruiting local attorneys, bankers, business people, and other trusted community figures in towns and cities across the country to serve as correspondents, filing reports on local merchants and business people who applied for credit. At its peak, the agency and its successors, which eventually became Dun & Bradstreet, had tens of thousands of such correspondents operating across the country, each assessing credit risk in their local area and reporting their findings upward to a central operation that organized and sold the accumulated information to subscribing businesses. This was the germ of the modern credit bureau, but it was still an extraordinarily human and subjective enterprise, dependent on the judgment, the biases, and the personal connections of individual correspondents reporting on their neighbors. These correspondents wrote their reports in plain language, making observations about a subject's reputation, their social standing, their domestic circumstances, the steadiness of their business, their apparent character. They used their own judgment about what was relevant, and their judgments reflected the world they lived in completely and without apology. A successful correspondent was someone with broad social connections, a person who moved in enough circles to know who was known to pay their debts and who was not, and whose judgment about character and standing was trusted by the subscribing businesses that paid for access to the reports. Robert Dunn, who acquired the Mercantile Agency in 1859 and built it into one of the largest credit reporting operations of the era, oversaw a system that treated the race, gender, and national origin of the people being evaluated as straightforward inputs into creditworthiness assessment, not because the correspondents were unusual in their prejudices, but because those prejudices were the ambient common sense of 19th century American life, absorbed into the credit reporting system as naturally as air. This detail is crucial for what comes next, because those early correspondents were not reporting purely on financial behavior. They were reporting on character, on reputation, on social standing, on the kind of person someone was understood to be within their community, and the kind of person someone was understood to be in 19th century America was shaped powerfully and explicitly by their race, their gender, their religion, their national origin, and their social class. A black businessman in the post-Civil War South faced a credit reporting apparatus that systematically treated his word as less reliable, his business as less sound, his risk as higher, not because of anything in his actual payment history, but because of what the correspondents who evaluated him believed about people who looked like him. It is worth being specific about how thoroughly these biases were institutionalized rather than confined to individual prejudice. Credit reporting codes used by the major agencies in the 19th century included explicit racial classifications, with different symbols or letter codes used to flag the racial background of the subject being reported, information that subscribing businesses were then free to use however they saw fit. Bankruptcy laws, property laws, and the general structure of the American legal system in this era compounded the disadvantage further, since Black Americans faced not merely biased individual assessments, but structural legal barriers to accumulating the kind of property and creditworthy track record that would have improved their assessments over time. The bias was not incidental to the system's operation in this period. It was one of the system's primary functions, serving to concentrate credit access within the white male property-owning class that the economy of the era was most transparently structured to serve. A woman seeking credit of any kind faced a system that treated her as fundamentally less creditworthy than a man, often denying her any independent credit history at all. Since her financial existence was legally and practically subsumed within her husband's in ways that made the accumulation of an independent credit record essentially impossible. Consumer credit bureaus, as distinct from the commercial credit agencies like Dun & Bradstreet that emerged from the Mercantile Agency, developed separately, beginning in the late 19th and early 20th century. As retailers and merchants offering installment credit wanted a way to track which individual consumers had reliably paid their debts and which had not. These early consumer bureaus were often locally organized, some run by retail merchants associations, others by individual businesses, and they shared negative information about consumers who had defaulted, slow paid, or committed fraud, while over time developing the capacity to share positive payment history as well. The early consumer bureaus collected information about individual household finances that was, even by the standards of the day, sometimes startlingly intimate, including information about marital disputes, drinking habits, employment difficulties, and personal reputations, since all of these were considered relevant to the question of whether someone could be trusted to pay their bills. The bureau was, in a genuine sense, an extension of the small-town knowledge economy into the larger, more anonymous cities and transactions of industrial America, attempting to recreate the personal familiarity of a tightly knit community at a scale where personal familiarity was no longer possible, that it reproduced the biases of those same small-town knowledge economies, along with their useful features, was, in retrospect, entirely predictable, even if it was not, at the time, widely recognized or challenged. Women's relationship to this system, through most of its history, deserves specific attention because it illustrates how a system built around personal reputation could exclude an entire group, not through explicit malice, but through structural assumptions so deeply embedded that they were rarely even examined. Through most of the 19th century and well into the 20th, married women in the United States had limited independent legal standing in financial matters. A married woman's debts were, in most legal frameworks, her husband's debts. Her property, including property she had brought into the marriage, was in many states legally controlled by her husband. The practical consequence of this legal structure for credit reporting was that a married woman typically had no independent credit record at all, since her credit accounts were held in her husband's name, and any positive payment history she accumulated was recorded against him, not her. If she was widowed or divorced, she might discover that decades of responsible household financial management had left her entirely invisible to the credit reporting system, with no independently documented record of financial reliability whatsoever. Through most of the 19th century and well into the 20th, married women in the United States had limited independent legal standing in financial matters. A married woman's debts were in most legal frameworks her husband's debts. Her property, including property she had brought into the marriage, was in many states legally controlled by her husband. The practical consequence of this legal structure for credit reporting was that a married woman typically had no independent credit record at all, since her credit accounts were held in her husband's name, and any positive payment history she accumulated was recorded against him, not her. If she was widowed or divorced, she might discover that decades of responsible household financial management had left her entirely invisible to the credit reporting system, with no independently documented record of financial reliability whatsoever. Through most of the 19th century and well into the 20th, married women in the United States had limited independent legal standing in financial matters. A married woman's debts were in most legal frameworks her husband's debts. Her property, including property she had brought into the marriage, was in many states legally controlled by her husband. The practical consequence of this legal structure for credit reporting was that a married woman typically had no independent credit record at all, since her credit accounts were held in her husband's name, and any positive payment history she accumulated was recorded against him, not her. If she was widowed or divorced, she might discover that decades of responsible household financial management had left her entirely invisible to the credit reporting system. With no independently documented record of financial reliability whatsoever. This is the context in which the Equal Credit Opportunity Act's specific provision requiring creditors to report credit information in the name of both spouses on joint accounts becomes genuinely significant. Before that requirement, a joint account was typically reported only in the husband's name, meaning that a couple who shared a credit card for 20 years would, at the end of those 20 years, have a 20-year credit history for the husband and a credit history of essentially zero for the wife, an outcome that disadvantaged women in the credit market in ways that were structurally embedded in the reporting system, rather than reflecting anything about their actual behavior with money. This is where things began to shift again, quietly at first. Through the first half of the 20th century, consumer credit bureaus multiplied and professionalized while remaining highly local. A consumer's credit record might exist in one city's bureau, but be entirely unknown to a bureau in the next city, meaning that moving could effectively erase a bad credit history or lose a good one. Some people understood this, and a pattern emerged in which the ability to move and start fresh with a clean slate, at least from a credit bureau's perspective, was available to anyone with the means and willingness to relocate, while those with fewer options remained tied to the record they had built in their current community. The post-war expansion of consumer credit, as installment buying of cars, appliances, and eventually homes became a central feature of the American economy, created growing pressure towards standardization and scale. Local bureaus that had once served the merchants and lenders of a single city needed to develop the capacity to exchange information with one another, and the proprietary information systems they used were often incompatible, making that exchange slow and unreliable. The computerization of credit reporting, beginning in the 1960s and accelerating through the 1970s and 1980s, gradually enabled the consolidation of the previously fragmented local bureau system into the three large national bureaus that dominate the landscape today, each maintaining a centralized database of credit information covering most credit-active adults in the country, rather than the residents of a single city or region. This consolidation was both enormously practically useful, enabling national lenders to make rapid, consistent decisions across the entire country, and the source of genuine new concerns, since centralized databases containing sensitive financial information about the entire adult population represented a novel kind of power that the legal frameworks developed to regulate local bureaus had not been designed to address. And it is precisely here that the transformation from local, subjective, correspondent-based reputation systems towards something resembling the modern algorithmic credit score began to take shape. The sheer volume of consumer credit applications, reaching scales that made individual human judgment impractically slow and expensive, created demand for something faster, more consistent, and more scalable. A bank evaluating tens of thousands of mortgage applications in a year needed a way to make those evaluations that did not require a human loan officer to personally investigate every applicant's local reputation. This practical pressure is what gave Bill Fair and Earl Isaac their opening. Let us bring together everything we have gathered so far, the mechanism from earlier, and the history we have just walked through, because this is the point where they finally lock together into something you can actually use to make sense of the news. What the whole arc of this history reveals, traced from the shopper at a counter to the algorithm processing your mortgage application, is something genuinely worth sitting with. The ancient problem of assessing trustworthiness across the distance between strangers has been attacked repeatedly by every generation that had to deal with it, using the best tools available to each. The solutions have gotten more consistent, more scalable, and more empirically grounded with each successive iteration. They have also, at each iteration, encoded the assumptions and limitations of their own moment into a system that the next generation then inherits and finds, once again, to be imperfect. This is not a story of failure, and it is not a story of inevitable progress. It is the more modest, more honest story of the real, recurring human problem being approached with genuine effort and genuine limitation across many generations without any final resolution in sight. Understanding this does not make the number that follows you any more or less accurate, but it does make it considerably more comprehensible and considerably less threatening to know that the number is a product of this history rather than a verdict from on high. A statistical estimate produced by a human system with a complex history is something you can understand, question, and relate to on roughly human terms. A divine verdict about your worth and reliability as a person is something that would sit very differently in the mind. The credit score, properly understood, is emphatically the first of these two things. What it sometimes feels like, in the anxiety of a financial moment, is the second. And closing that gap between what the number actually is and what it can feel like it is part of what tonight's conversation has been trying to do. Consumer credit, long a secondary concern compared to commercial credit between businesses, began expanding dramatically in the post-war period as installment buying became a central feature of American economic life. The scale of this expansion created a genuine practical problem for lenders. A single bank or retailer might be evaluating thousands of credit applications from individuals with whom it had no prior relationship and no personal knowledge, and the informal, judgment-based methods that had worked for smaller volumes of commercial credit between business parties were simply too slow, too expensive, and too inconsistent to apply at mass consumer scale. The magnitude of this expansion is worth appreciating concretely because it makes the urgency of the search for something more scalable genuinely comprehensible. In 1945, total consumer debt outstanding in the United States was modest. By 1960, it had multiplied several times over. By the 1970s and 1980s, with the credit card becoming a mass consumer product rather than a privilege of the upper middle class, the volume of consumer credit decisions being made daily across American financial institutions had become staggering. A scale at which the idea of a human loan officer personally evaluating every applicant's individual circumstances had become simply untenable. The pressure to automate and standardize was not a choice among alternatives. It was a response to a genuine logistical problem for which the human judgment model had simply run out of capacity. The expansion of the credit card is itself worth tracing briefly as a chapter within this larger story, since it accelerated the demand for standardized, rapid credit evaluation more than any other single development. The first bank-issued credit cards appeared in the late 1950s, and through the 1960s, and early 1970s, the major card networks developed the infrastructure to enable credit cards to be used at essentially any merchant willing to accept them, rather than being limited to the issuing bank's own customer relationships. This transformation turned credit card lending from a relationship-based activity where a bank extended credit to existing customers it knew into a mass-market product where banks were soliciting applications from strangers across the country and needed to make rapid, consistent decisions about millions of applicants with no existing relationship to the institution. The demand this created for a fast, reliable, nationally consistent creditworthiness assessment was enormous, and it created exactly the market conditions in which a standardized scoring model could gain the scale it needed to become genuinely dominant. The statistical approach that would eventually become the modern credit score grew from this practical pressure. Rather than asking, "What do we know about this particular person's character and reputation?" lenders began asking a different question. What do we know about people with these particular financial characteristics, and how reliably have people with those characteristics repaid their debts in the past? This was a profound conceptual shift. The individual being evaluated was no longer being assessed primarily as an individual, but as an instance of a type, a data point whose past behavior could be used to predict the future behavior of statistically similar data points. This shift had a virtue and a limitation, both of which are worth naming clearly. The virtue was consistency. A statistical model, applied the same way to every applicant, could not be talked into leniency by a charming applicant, could not be swayed by an applicant's physical appearance, could not be influenced by whether the loan officer happened to have slept well or had a bad day. The same inputs would always produce the same output, regardless of who the applicant was or who the loan officer happened to be in that particular moment. The limitation was the inverse of the same feature. A statistical model applied the same way to every applicant could also not take into account the specific circumstances that might make an application that looked risky on paper actually represent a reasonable bet. A recent graduate just beginning their career, someone who had just emerged from a temporary but disruptive life event, someone whose thin credit file reflected a deliberately cash-based lifestyle rather than any history of financial failure. The model saw patterns, not people, and the patterns it had been trained on encoded whatever regularities existed in the historical data it was built from. Bill Fair and Earl Isaac's key insight, developed through the 1950s and 1960s, was that a statistical model trained on actual historical repayment data could predict future default risk more accurately than human loan officers relying on personal judgment, and that this model could be applied consistently and rapidly across a large volume of applications at a cost far lower than individual underwriting. Their early models were applied first in specific industry contexts, and the reception from lenders was initially cautious, since the idea of replacing the judgment of an experienced human loan officer with a mathematical formula struck many in the industry as both reductive and risky. The early FICO scores were sold to skeptical lenders partly on the basis of a guarantee. The models would be tested against actual historical data to demonstrate their predictive accuracy, and any lender could compare the model's predictions against their own portfolio's actual outcomes to verify whether the scores were genuinely predictive in their specific lending context. This empirical, testable framing was crucial to the score's eventual adoption, since it positioned the model not as a replacement for lender judgment, but as a tool that lenders could evaluate on their own terms against their own data. FICO scores becoming more broadly available to lenders through the late 1980s, and then becoming the near universal standard across consumer lending in the United States after Fannie Mae and Freddie Mac, the government-backed mortgage companies, began requiring FICO scores for all mortgage applications they would consider purchasing in the early 1990s. This single requirement, more than any other development, cemented the three-digit FICO score as the dominant standard in American consumer finance, since any lender that wanted to sell mortgages into the secondary market, which was by then most of them, needed to operate within the FICO framework, a requirement issued by two government-backed entities with enormous market power effectively standardized a private company's proprietary scoring model as the de facto national standard for lending decisions across the entire country, an outcome that no single piece of legislation had created, but that market structure had quietly produced through the accumulation of many individual rational business decisions. The decades during which these systems became entrenched also witnessed a significant, hard-fought legal battle over the discriminatory practices that had characterized credit reporting from its earliest days. The Fair Housing Act of 1968 and the Equal Credit Opportunity Act of 1974 prohibited discrimination in lending on the basis of race, religion, national origin, sex, and marital status, explicitly barring creditors from using these characteristics in their credit decisions. The Equal Credit Opportunity Act was particularly significant for women, who had previously been routinely denied independent credit accounts, required to have a male cosigner for any credit application, or had their credit applications assessed based on assumptions about their likely future income, with lenders frequently discounting women's earnings on the theory that they were likely to leave the workforce to raise children, a practice that systematically disadvantaged women, regardless of their actual income or payment history. The passage of the Equal Credit Opportunity Act was not a smooth or uncontested process. Many in the credit industry argued that the proposed restrictions would make it impossible to manage lending risk accurately, since the characteristics being prohibited as bases for decisions were, they claimed, genuinely predictive of creditworthiness in their experience. Consumer advocates and civil rights organizations countered that whatever predictive correlation lenders believed they had observed was itself the product of a discriminatory system. That women had lower measured creditworthiness partly because they had been denied the opportunity to build credit histories in the same ways that men had, and that treating the discriminatory outcome as legitimate evidence for continued discrimination was simply entrenching the original injustice rather than correcting it. This debate, conducted in congressional hearings and regulatory comment processes in the early 1970s, presaged the same arguments that researchers continue to make today about disparate impact and the relationship between historical discrimination and current credit score distributions. The arguments did not resolve then, and they have not resolved since, but the legislative outcome did, at minimum, strip the most explicit, facially discriminatory practices from the formal, legal structure of American credit markets. The Fair Credit Reporting Act of 1970 established, for the first time, a legal framework governing what information credit bureaus could collect and report, how long negative information could remain on a report, and what rights consumers had to access and challenge their own records. These laws represented a genuine and significant effort to reform a system whose discriminatory practices had by that point been well documented and were widely understood to have systematically excluded large portions of the American population from access to fair credit, often for explicitly racial and gendered reasons. Whether these laws succeeded fully in eliminating discriminatory outcomes is a genuinely contested question among researchers, and one worth engaging with honestly. Because modern credit scoring models explicitly exclude race, religion, gender, and national origin as direct inputs, proponents argue they represent a genuinely neutral, objective system that evaluates only financial behavior and therefore delivers genuinely equal treatment. Critics respond that a model that excludes these variables directly can still produce outcomes that differ systematically by race, gender, and class. If the variables it does use as inputs are themselves correlated with race and class in ways that reflect historical discrimination, the argument on this side of the debate is rooted in a concrete and well-documented historical chain, beginning in the 1930s and continuing for decades afterward. A federal government program mapped American cities and neighborhoods by perceived lending risk, color-coding maps used by mortgage lenders. Neighborhoods deemed highest risk were typically marked in red, and these red-marked neighborhoods were overwhelmingly black neighborhoods, effectively barring the residents of those areas from access to government-backed mortgage loans, regardless of their individual creditworthiness. This practice, known as redlining, was not a fringe or informal discrimination. It was a deliberate, government-sanctioned policy, applied systematically across American cities for decades, and its consequences compounded over time. Since homeownership was the primary mechanism by which middle-class American families built and transmitted wealth across generations, families prevented from buying homes in stable, appreciating neighborhoods during the post-war decades did not merely miss those particular homes. They missed the equity, the financial stability, and the intergenerational wealth transfer that those homes would have enabled. And their descendants entered the financial system decades later with fewer assets, in neighborhoods with less stable economic conditions, and with family financial histories that simply looked different from those of families who had been allowed to participate. A community that was explicitly denied mortgage access for decades under explicitly racist policies will, as a statistical consequence, have residents with shorter credit histories, fewer assets, and less access to the kinds of mainstream credit products that build scores, meaning a scoring model that never mentions race can nonetheless systematically produce lower scores in that community as a downstream consequence of discrimination that the model itself is entirely silent about. This is what researchers mean when they say that a neutral model can produce disparate outcomes. They are not accusing the model's designers of conscious racism. They are observing that a model trained on data from a world shaped by discrimination will encode the outcomes of that discrimination, even when it explicitly excludes the discriminatory variables. This debate is genuine, ongoing, and unresolved among economists and policymakers, and it represents one of the more important and difficult questions surrounding the modern credit system. There is genuine, ongoing debate among researchers and policymakers about several further aspects of this picture, worth being honest about rather than pretending the field is more settled than it truly is. One significant development has been the gradual, contested expansion of what credit scores are used for, well beyond their original purpose of predicting repayment risk for lending decisions. Landlords using credit scores to screen tenants, employers using them in hiring decisions in industries where such practices are permitted, insurance companies using credit-based insurance scores to price auto and homeowners policies, represent extensions of the credit scoring apparatus into domains where the connection to financial risk is considerably less direct and considerably more contested than in straightforward lending. Consumer advocates have argued that these expanded uses impose unfair barriers on people with low scores for reasons that have little to do with their actual behavior in those specific contexts, since someone's likelihood of filing an auto insurance claim is not obviously predicted by whether they paid a credit card on time. The use of credit scores in employment decisions has drawn particularly sharp criticism from those who argue that it creates a feedback loop genuinely difficult to escape. Someone who has experienced financial difficulty may have a lower credit score, which makes it harder to get the kind of stable employment that would help address the financial difficulty, which in turn makes it harder to improve the credit score. Several states have moved to restrict or ban the use of credit information in insurance pricing and employment decisions, reflecting this ongoing, genuinely contested disagreement about the appropriate scope of a system originally designed for lending. Industry representatives respond that the statistical correlations underlying these uses are genuine, even if imperfectly understood, and that using available predictive information is simply rational risk management. The debate here turns on genuinely contested, empirical, and normative questions that do not have simple, settled answers. A second significant area of ongoing debate concerns the design of the credit score system itself and its incentive structures, because building a credit history requires having credit. The system creates a genuine barrier for people who are new to a country, young adults beginning their financial lives, or people who have historically operated primarily in cash, all of whom may be financially responsible in every practical sense, but lack the specific documented track record the scoring models require. This is sometimes called the credit invisibles problem, referring to the tens of millions of adults in the United States who have no credit file at all, or whose file is so thin that a reliable score cannot be calculated from it, and who are, therefore, essentially excluded from mainstream lending not because of any demonstrated financial failure, but simply because the system has no record of them. The circular trap embedded in this problem is genuinely frustrating for many people encountering the credit system for the first time. To get credit, you need a credit history. To have a credit history, you need to have had credit. The system has no mechanism for recognizing responsible financial management that occurs outside its own record keeping. No way to take into account the tenant who has paid rent on time for 10 years, the consumer who has never carried debt because they saved before spending, the immigrant who arrived with strong financial habits and no American credit file. For each of these people, the absence of a credit record looks to the scoring model indistinguishable from the presence of a bad one, since both result in either no score or a very low score, even though they represent entirely different underlying realities. Several initiatives have emerged in recent years attempting to address this limitation, including the incorporation of alternative data, rental payments, utility bills, and bank account cash flows. That might give creditworthy people without traditional credit histories a documented record of financial reliability. The underlying premise is appealing. If a person has consistently paid their rent on time for years, that is genuine evidence of financial reliability that the existing scoring system has simply chosen not to count. Some programs have found that incorporating rental payment history does meaningfully help thin-file or no-file applicants access credit they would otherwise have been denied. The uptake and reliability of these alternative data initiatives remains an active area of development and debate, with genuine uncertainty about whether incorporating these additional data streams helps more than it potentially harms, since some alternative data sources may also carry demographic correlations that could inadvertently introduce new forms of bias into scoring models. If, for example, the neighborhoods where people are most likely to pay rent in cash rather than through trackable electronic transfers are also the neighborhoods most heavily populated by lower-income minorities, then requiring trackable rent payment records as a condition of building credit history could inadvertently disadvantage exactly the people the initiative was designed to help. These are genuinely difficult design questions without clear right answers, and the people working on them are navigating real trade-offs between inclusion and accuracy, between helping creditworthy people access credit and avoiding the introduction of new proxies that encode the same old biases, in new forms. There is a third significant area of ongoing debate and policy development worth understanding, one that has grown considerably in importance as the volume of sensitive financial data flowing through the credit bureau system has increased: the risk of data breaches and identity theft. Because the three major credit bureaus maintain detailed financial records on essentially all credit-active adults in the country, they represent extraordinarily valuable targets for criminal actors seeking to commit identity fraud. A successful breach of a major bureau's systems can expose the financial records of tens of millions of people simultaneously, providing criminals with exactly the information needed to open fraudulent credit accounts in victims' names, damage the credit of people who had no knowledge of the fraud, and create years of difficult, time-consuming remediation for the individuals affected. Major breaches of credit bureau data have occurred on multiple occasions, affecting tens of millions of consumers. And these incidents have raised genuine policy questions about whether private companies should be trusted to maintain such comprehensive databases of sensitive financial information on the entire adult population with the current level of regulatory oversight. Consumers who discover or suspect that their personal information may have been compromised can request that credit bureaus place a security freeze on their file, preventing any new credit accounts from being opened in their name until the freeze is explicitly lifted. This is one of the more powerful practical tools available to anyone concerned about the misuse of their credit information, though it does require active management, since the freeze must be temporarily lifted every time you yourself want to apply for new credit, and must be placed separately at each of the three major bureaus. Some states have strengthened consumer rights in this area beyond the federal baseline, and the regulatory landscape continues to evolve as policymakers weigh how to balance the genuine commercial and credit access benefits of the existing system against the very real privacy and security risks associated with maintaining comprehensive financial data on virtually every adult in the country in systems that have proven more than once to be vulnerable to large-scale breach. So what does all of this mean for us? Not for researchers studying discrimination and policymakers debating reform, but for the quiet daily life that most of us are actually living, lying here in the dark, thinking about a number we may not know precisely, wondering whether it is good enough, whether some past mistake is still affecting us, whether we understand the system well enough to navigate it. It is worth pausing before we reach the myths to notice something worth naming directly. The system we have just traced, from the shopkeeper's personal knowledge to the Mercantile Agency's correspondence to the algorithmic FICO model, has moved steadily in the direction of appearing more objective, more neutral, more beyond reproach with each successive step. The correspondent who filed a frankly biased assessment was visibly human and therefore visibly fallible. The statistical model that calculates a number from your payment history looks like mathematics, and mathematics looks like truth. There is a quality of finality and authority to a number that a paragraph of personal opinion simply does not have, even when both are drawing on equally imperfect underlying information and equally contingent prior assumptions. This appearance of mathematical objectivity is one of the most consequential features of the modern credit score, precisely because it makes the underlying assumptions, the choices about what to measure, what to exclude, and how to weight each factor, harder to see and therefore harder to question. Understanding that the number is not mathematics descending from a purely neutral sky, but a human artifact produced by human choices made at a specific historical moment for specific practical reasons, is the single most important reframing available when thinking about what a credit score actually represents. The score carries authority because it looks like certainty, knowing that it is a well-designed estimation tool rather than a fact of nature. does not strip it of its authority in the institutions that use it, but it does change your relationship to it and to the quiet anxiety it sometimes generates when you understand clearly what it is and what it is not. So, what do we do with all of this? Let us start by dismantling a few myths. Gently, now that we have the full picture in front of us. The first myth is that your credit score is a measure of your worth as a person, or of your character, or of how good you are with money in any deep sense. It is none of those things. It is a statistical estimate produced by a proprietary model of the probability that someone with your specific combination of credit history characteristics will default on a debt within the next 24 months. That is the actual narrow question the score is designed to answer. It says nothing about your work ethic, your financial intelligence, your values, or the quality of your decisions over a lifetime. It does not know that you went through a divorce, or a medical emergency, or a job loss, or a period of caring for a dying parent. It knows only what happened to your credit accounts during those periods, filtered through a statistical model optimized for prediction rather than understanding. There is something worth sitting with in that last point, because it explains a great deal of the specific frustration people feel when their score does not seem to reflect what they know to be true about their own financial character. You can be a careful, responsible, trustworthy person who genuinely honors their financial commitments and still have a credit score that does not reflect that, because a period of genuine hardship left marks on the record that the model weights heavily without the model having any way to know what was happening in your life at the time. You can be someone who has never missed a payment in your life and still have a thin credit file that produces only a modest score, simply because you have not used enough of the kinds of credit products the model was trained on. The score, at its best, is a fair and consistent proxy for a certain kind of financial track record. At its edges, it can feel like a deeply unfair misrepresentation of a more complex reality. Both of these things are true simultaneously, and the tension between them is built into the design of any system that tries to reduce human financial history to a single number. The shopkeeper who extended credit based on knowing someone personally was assessing character, however imperfectly. The algorithm assessing your FICO score is not assessing your character at all. It is pattern matching your financial record against historical default rates and producing a probability estimate. These are very different things, even when they produce the same 3-digit number. The second myth is that the score is fixed, permanent, and beyond your influence. In reality, a credit score is a dynamic calculation recomputed each time a lender requests it, based on whatever information happens to be on your credit report at that specific moment. It can and does change over time, sometimes gradually, sometimes more quickly when a significant change occurs in the underlying report data. Negative information does not stay on a credit report forever. Most derogatory marks, missed payments, collections accounts, and similar items fall off a credit report after 7 years in the United States, with the significant exception of bankruptcy, which can remain on a report for up to 10 years. The way negative information ages off a credit report follows a specific, legally defined timeline, which is worth understanding because it directly affects how much anxiety is actually warranted about a specific past event. A missed payment that occurred 6 years and 11 months ago will disappear from your credit report within weeks, and your score will recalculate the following month without that entry. This is genuinely different from many other aspects of financial history, which do not expire in the same way. A landlord who checks your background informally may remember a story they heard years ago. A small community may carry institutional memory of a business failure for decades, but the formal credit reporting system has a legally mandated memory of exactly 7 years for most negative events. and the scoring model weights recent events considerably more heavily than older ones within that 7-year window. This means that time itself is, in a real sense, the most powerful force available to someone working to improve a damaged score. Since a missed payment from 6.5 years ago will have considerably less impact on a score than a recent one, and will disappear from the report entirely within a relatively short further period. The scoring models are also specifically designed to weight more recent information more heavily than older information, meaning that a sustained period of positive behavior, payments made on time, balances kept low will, over time, meaningfully dilute the impact of past difficulties. The score is not a permanent verdict. It is a rolling estimate, continuously updated with new evidence. The third myth, and perhaps the most practically costly one for people navigating their own financial lives, is that closing credit card accounts you no longer use will help your score. This is exactly backwards from what actually happens. Closing an account reduces your total available credit, which, if you are carrying any balances on other accounts, immediately raises your credit utilization ratio, the proportion of your available credit that you are currently using, which is the second largest factor in your score. Closing an older account can also shorten the average age of your credit history, reducing that component of the score as well. Consider a specific illustration. Suppose you have 2 credit cards, one that you use regularly with a limit of $5,000 and a balance of $2,000, and one you opened years ago and no longer use, sitting at a zero balance with a limit of $5,000. Your total available credit is $10,000 and your total balance is $2,000, giving you a utilization rate of 20%, which is generally considered healthy. If you close the unused card, your available credit drops to $5,000 while your balance stays at $2,000, and your utilization rate immediately doubles to 40%, a level that would noticeably lower your score, all else being equal. You have not changed your behavior in any meaningful way. You have not become a higher default risk. The statistical model has simply recomputed a number that weighs one of its inputs differently because you removed an account that was, while unused, genuinely useful to your score. In most circumstances, an unused credit card that is not costing you anything in annual fees is doing more good to your score by sitting open and unused than it would do if you closed it. A genuinely counterintuitive fact that contradicts many people's instinct that carrying fewer accounts is safer or cleaner from a credit perspective. The score is not measuring tidiness. It is measuring your track record of responsible credit use over time, and a long history of unused available credit is, from the model's perspective, evidence of exactly that. A fourth myth worth addressing directly is the belief that checking your own credit score will hurt it. As we discussed in the mechanism section, checking your own score through any consumer-facing service registers as a soft inquiry and has no effect on your score whatsoever. The mistaken belief that self-checks are harmful leads some people to avoid monitoring their own credit entirely, which means they may be unaware of errors on their report or of gradual changes, positive or negative, in their score. You cannot hurt your own score by looking at it. You can only miss information you might want to have. In fact, the Fair Credit Reporting Act was specifically designed to make this kind of consumer self-monitoring both possible and consequence-free. Recognizing that a person's ability to check and understand their own credit record was a genuine consumer right rather than a threat to the system's integrity. Let us also address the specific fear that surfaces most reliably around this topic: the quiet anxiety that a mistake somewhere in the past, a missed payment, a collection account, a period of genuine financial difficulty has damaged your credit in a way that cannot be repaired, that you are somehow permanently marked. This fear, while understandable, consistently overstates the permanence of negative credit information. The system is, as we have discussed, a time-limited one, and the scoring models themselves are specifically designed to weight more recent information more heavily than older information. The original shopkeeper's question about trust had an answer that could change as new evidence accumulated. The modern statistical model that answers that question is, in this specific respect, actually somewhat more forgiving than the town gossip it eventually replaced. A town's collective memory could hold a past failure against someone for decades. The credit scoring model holds the same failure for 7 years and weights it progressively less heavily as time passes. This is not an argument that the system is without flaws. It is simply an accurate description of how it actually works, which differs meaningfully from the fearful version many people carry. There is also a practical dimension to this point worth naming clearly. Someone who has experienced a genuine financial crisis, a bankruptcy, a stretch of missed payments during a medical emergency, or a job loss, often carries the belief that their credit is permanently ruined for a very long time after the situation has actually begun to improve, because the most severe negative marks are the ones that feel most vivid and most consequential. People in this situation often stop checking their credit at all, assuming the worst, and miss the fact that positive new information has been accumulating alongside the old negative entries, gradually shifting the score in a better direction. Checking in on your own credit after a difficult period, even when you expect to find bad news, sometimes reveals a situation that is already better than you feared. Because the scoring model has already been quietly weighting the more recent positive behavior more heavily than the earlier difficulties. The fear of looking is itself a cost, one that can be reduced simply by understanding that the system's own design already treats your most recent behavior as more important than your oldest mistakes. Let us also address the specific fear that surfaces most reliably around this topic: the quiet anxiety that a mistake somewhere in the past, a missed payment, a collection account, a period of genuine financial difficulty has damaged your credit in a way that cannot be repaired, that you are somehow permanently marked. This fear, while understandable, consistently overstates the permanence of negative credit information. The system is, as we have discussed, a time-limited one, and the scoring models themselves are specifically designed to weight more recent information more heavily than older information. The original shopkeeper's question about trust had an answer that could change as new evidence accumulated. The modern statistical model that answers that question is, in this specific respect, actually somewhat more forgiving than the town gossip it eventually replaced. A town's collective memory could hold a past failure against someone for decades. The credit scoring model holds the same failure for 7 years and weights it progressively less heavily as time passes. This is not an argument that the system is without flaws. It is simply an accurate description of how it actually works, which differs meaningfully from the fearful version many people carry. It is worth adding, as a kind of coda to all of this, that the entire apparatus we have been discussing, the 3-digit score, the 3 major bureaus, the Fair Isaac models, the legal protections of the Fair Credit Reporting Act, is a specifically American construction in its particular form. Other countries have developed their own approaches to answering the shopkeeper's ancient question, and not all of them look like the American system. Some countries maintain more centralized, government-operated credit registries rather than competing private bureaus. Some countries place much stricter limitations on how widely credit information can be shared, and for what purposes. Some countries give consumers considerably more control over their own credit records than American consumers currently possess. The United Kingdom uses a broadly similar bureau-based system, but with different legal protections and different specific scoring models. Germany and other Northern European countries have historically relied more heavily on a system built around the concept of negative reporting only, where a clean absence of negative marks is the default assumption, rather than the American model in which positive credit history actively needs to be built and documented. The American credit scoring system, in other words, is not the only possible answer to the ancient question of how to evaluate whether a stranger can be trusted with money. It is a specific, historically contingent answer, built from the particular legal, institutional, and commercial context of 20th century America. And it carries that context inside it, just as every institution built by people in a specific time and place inevitably does. So, what do we do with all of this in practical terms? The answer, and this might be the least satisfying part of everything we have explored tonight, is that there is no single answer. The economy is not a machine you can tune with a screwdriver. It is billions of people making decisions every day, and the patterns that emerge are real but not fully controllable. What we have done tonight is not give you a strategy. It is give you the words, the framework, the understanding you need to make sense of the headlines, to ask better questions, and to sit with uncertainty without it turning into fear. For the rest, the decisions about what to do with your own resources, that is, between you and your own judgment, ideally informed by professionals who understand your specific situation. What we have done tonight is give you something quieter, but maybe more lasting. The ability to see the system clearly, and sometimes that is enough. There is a quiet, human thread running underneath everything we have covered tonight, worth pulling into the light before we let this rest. Lewis Tappan's Mercantile Agency, with its network of correspondents reporting on neighbors, trying to answer the oldest question in commerce. The drapers and ironmongers of industrial Manchester, comparing notes over a shared list that could not follow a customer who had moved to the next city. Bill Fair and Earl Isaac, building statistical models in the 1950s to try to make that same ancient answer more consistent, more reliable, more scalable than any single human judge could manage. The legislators who spent years fighting to strip the most explicit discriminations out of a system that had embedded them, honestly and without apology, since its earliest days. The researchers who still argue, with genuine evidence on both sides, about whether those discriminations were ever fully removed or simply hidden inside variables that carry their history without naming it. And the shopkeeper, going back further than all of them, looking at a neighbor across a counter and making a judgment that was never purely about money, but about trust, about familiarity, about knowing someone, about the thousand small signals that tell us, rightly or wrongly, whether a stranger will keep their word. It is worth remembering that almost none of the people who built the successive layers of this system were cynical or malicious in their own framing of what they were doing. Lewis Tappan genuinely believed he was providing a service that would make commerce more honest and more efficient. The correspondents who filed biased reports about their black or immigrant neighbors were, in the vast majority of cases, simply transmitting the ambient beliefs of their society. The statisticians at Fair Isaac genuinely believed they were replacing subjective human bias with something more consistent and more fair. The legislators who passed the Equal Credit Opportunity Act believed they were building the protections needed to complete the work of removing discrimination from the system entirely. Each generation inherited a system from the previous one, found its flaws, and tried to improve it, without any of them being able to see from inside their own moment. quite what they were leaving for the next generation to inherit and grapple with. This is the shape of human institutions in general. And the credit system is in this sense no different from any of the others we have traced together on these evenings, a series of sincere, imperfect attempts to solve a real problem. Each solution creating its own new problems, each reform leaving its own unfinished work. The credit score is, in a sense, society's attempt to systematize the shopkeeper's judgment to make it portable, consistent, and scalable across millions of strangers in a way that the shopkeeper's personal knowledge could never be. Whether it has succeeded in producing something genuinely fair, in the full sense of that word, rather than merely something technically neutral, is one of the more honest, more difficult, and more unresolved questions that the entire system continues to pose. It is a question that the three-digit number itself, appearing as a clean mathematical verdict, gives you very little help in asking. Tonight, we have tried to give you the tools to ask it anyway. Several countries around the world are observing the American system from a distance and making deliberate choices about whether and how to adopt similar approaches. With some choosing stricter privacy protections than American consumers currently enjoy, and others importing variations of the model that fit their own specific legal and commercial contexts, the system we have been exploring tonight is not a universal feature of all organized economies. It is a specific institution, built in a specific place and time, still being debated and reformed. The ongoing work of that reform, the research projects examining disparate outcomes, the legislative proposals to expand alternative data inclusion, the legal challenges arguing that certain uses of credit scoring cross the line from risk assessment into discrimination, is the current, living chapter of a story that began with a shopkeeper and a neighbor and a question about trust. The credit score is, in a sense, society's attempt to systematize the shopkeeper's judgment, to make it portable, consistent, and scalable across millions of strangers in a way that the shopkeeper's personal knowledge could never be. Whether it has succeeded in producing something genuinely fair, in the full sense of that word, rather than merely something technically neutral, is one of the more honest, more difficult, and more unresolved questions that the entire system continues to pose. It is a question that the three-digit number itself, appearing as a clean mathematical verdict, gives you very little help in asking. Tonight, we have tried to give you the tools to ask it anyway. You are lying there now, in the dark, perhaps thinking faintly of a three-digit number, real or imagined, and what it says or does not say about your financial life. The number is not you. It has never been you. It is a statistical estimate calculated by a proprietary model from data collected by private companies operating within a legal framework built up through decades of legislation and litigation. It is, like almost every structure in this economy, we have been slowly mapping together across these evenings, a human creation built to solve a human problem, carrying all the imperfections, all the contested history, and all the genuine usefulness of any tool built by people, for people, in a world that is never quite as simple as any single number could capture. If there is a worry sitting quietly underneath all of this for you tonight, it may help to know that you are in very good company. A very large share of the adults who carry a credit score carry it with only partial understanding of what it actually measures or how it actually works. The anxiety that forms around this particular number tends to be larger than the number probably warrants, partly because the consequences it carries are genuinely real, and partly because the opacity of the system, the proprietary formulas, the parallel reports that can differ from one another, generates a specific kind of free-floating worry that comes from not being able to see clearly what is being said about you and why. The single most effective remedy for this particular anxiety has always been the same. 1. Looking at the actual information, understanding how it was generated, and separating the reality from the fear. And what the history we trace tonight ultimately tells you, beneath all the specific details about bureaus and formulas and legislation, is that the number you carry was built by people who were trying their best to solve a genuine problem, who inherited a system they did not design from scratch, who made choices whose full consequences they could not always see, and who left the work of reform unfinished in ways they may not have recognized themselves. There is nothing in that history that makes the number more frightening than it already is. There is quite a lot in it that makes the number feel rightly more human, more contingent, and more manageable than the cold authority it projects. Think for a moment of the shopkeeper again. The question they were asking, quietly across that counter, was not really about credit at all. It was about trust, whether you could extend it carefully to someone who stood before you asking for it, whether the signals available to you, however limited, however biased, however partial, added up to something reliable enough to act on. That question, dressed in different clothes, running on different machinery, is still being asked every single time your credit is pulled. And now you know something of the long, complicated road it traveled to get from there to here. There is something worth carrying forward, in particular, from the more difficult chapters of this history. The early correspondents who filed reports on strangers were often confident in their assessments, confident in ways that their biases entirely justified to themselves. The statistical models that came later looked more neutral, more objective, more beyond reproach, and they were in some real ways more consistent and more reliable. But they also inherited, encoded in their data, the accumulated outcomes of the world those biased correspondents had helped create. This is one of the quieter lessons of tonight, and one of the more durable ones. A tool built from history carries that history inside it, even when the tool itself is designed to be neutral, even when the people who built it sincerely believed they had left the past behind. The economy is not a natural disaster happening to you. It is a human creation, shaped by human choices, made across centuries, by people solving the problems directly in front of them with the tools they happen to have. And we are inside it, all of us, together, still navigating, still negotiating, still arguing about whether the tools we have built are as fair as we intended them to be. And as you lie there, the world continues to turn. Somewhere, a credit report is being updated with a payment made or a payment missed. Somewhere, a lender is making a decision based on a score neither the applicant nor the lender fully understands how to question. Somewhere, a researcher is running the numbers on whether a system designed to be neutral is producing outcomes that are. And somewhere, a young person is applying for their first credit card, taking their first step toward building the record that will eventually become the number that follows them through their financial life, probably without anyone having explained to them, clearly and honestly, what that number actually is. And here, in the dark, none of it needs your attention. It simply is, as it always has been, as it will be tomorrow.